continued rise in oil price is a big threat to PH economy. The Philippines would be the hardest hit among emerging markets next year if global oil prices reach per barrel by year-end, according to the UK-based Oxford Economics. We see a risk that oil price rises have further to run, as the impact of United States sanctions on Iran bites. In the short run, it is likely the supply impact will be offset by higher production elsewhere, but the market is tightening and all it would take is one more shock to supply, such as Nigeria, and oil could reach, per barrel, Oxford economist John Payne and head of global macroresearch Gabriel Sterne said in an April 24 report titled Global Impact of Brent as per barrel. The oil price response to geopolitical tensions can be viewed in the context of historical episodes of increased Middle Eastern tensions. Our modeling work suggests the change in nominal oil price is a soft spike when the month is in a period of tension. Over the longer term, however, we recognize that higher short-term prices could encourage market oversupply and result in lower prices, it explains. Based on Oxford Economics simulations, oil prices hitting a barrel by the fourth quarter of 2019 would cut global gross domestic product, GDP, by 0.6% below baseline by end 2020. Oxford Economics said it had a baseline for Brent to bottom out at per barrel this quarter, before slowly rising back to an average of per barrel in 2019 and per barrel in 2020. Also, skyrocketing oil costs would push global inflation rate upward by an average of 0.7 percentage points during the same period, it said. As a worst-case scenario, Oxford Economics said global GDP growth would decline, dropping to 2.5% in 2020, while inflation would average 4% year-on-year in 2020, the sharpest spike in prices since 2011. It would be particularly damaging for already fragile, oil-importing emerging markets, such as the Philippines, minus 1.2% below 2020 GDP, Argentina, minus 0.9%. Turkey, minus 0.9%, and Indonesia, minus 0.8%. Oxford Economics said. Last year, the rate of increase in prices of basic commodities in the Philippines averaged a 10-year high of 5.2%, partly as global oil prices jumped during the third quarter of 2018. Amid high inflation, GDP growth slowed to a 3-year low of 6.2% last year. Last month, the government cut its 2020 GDP growth target to 6.5 minus 7.5% from 7 to 8% previously, citing external risks. Oxford Economics simulations show that China and India's GDP would also be reduced by 1.1% and 1%, respectively, next year if Brent prices climb to per barrel. According to Oxford Economics projections, the other losers to higher global oil prices included Spain, Hong Kong, France, the United Kingdom, South Africa, Brazil, Germany, Japan, the United States, Italy and Canada. On the other hand, advanced economies tend to use oil less intensively and so are less negatively affected, Oxford Economics noted, such that huge oil exporters such as Russia, Saudi Arabia and the United Arab Emirates would stand to benefit from higher global prices. Also seen as winners if oil prices rise are Norway, South Korea, Malaysia, Mexico and Australia. Thank you for watching. Please subscribe.